What's up everyone, it's Karthik with MoneyVest. So markets continue to be very undecided with where they want to go. We had very flat markets on the day. Tom Lee was also on CNBC just a few hours ago talking about exactly what we discussed in our yesterday's market update. And of course, Tesla delivery numbers also came out today, just a little bit shy of expectations, and the stock was down over 4.5%, close to 5% on the day here, with the S&P 500 flat, the NASDAQ flat, the Dow Jones also very flat. So all the three indices essentially not going anywhere. A very boring day, to be honest, apart from the Tesla's event, which was the delivery numbers, which again came in a little bit shy of expectations here. So Tesla stock falls as investors expected more robust deliveries, and they essentially reported 462,890 vehicle deliveries in the third quarter, which was a shy of 463,000. We did still see a 6.4% increase year over year and a little bit over 4% growth quarter over quarter. But of course, year to date, we are still down in the first 9 months by a little bit over 2.3% because we're just shy of 1.3 million vehicles compared to just over 1.3 million from same time last year. And Tesla would need to hit over 500,000 vehicles in the fourth quarter in order to get to almost 1.8 million vehicles. Last year in the fourth quarter 2023, Tesla delivered 485,000 vehicles, and so we would need to see at least a 4 to 5% growth on a year-over-year basis in the fourth quarter in order for Tesla to achieve that 1.8 million vehicle delivery mark and for essentially be flat on a year-over-year basis. Now, before we move further, please make sure that you drop a like and subscribe to the channel, and also share these videos, copy the link and paste it in other groups. Share it with your trader friends, investors, other folks that might be interested in learning more about the market. And of course, taking a look at these videos, it's recommendations and word of mouth like this that really help us grow our channel. We're very close to 85,000, so please do me a favor, like and share and subscribe to the channel here. So this right here is what I mentioned in our Discord. These are my calls and my shares on Tesla. Absolutely getting dumped here, up over 88% on the calls right now. So this right here is the covered calls that's acting as a nice hedge against my Tesla shares, which was a buy right. So I'm going to be closing these out either tomorrow or on Friday. So when they're up about 90 to 95%, preferably 95%, because I really want that premium to go down to zero and really not just pay anything back in premiums and lock in that profit of almost $700. That's going to be the premium that I received for selling these calls. And once they're up 95%, I will close these out and I will go ahead and sell new calls for next week. And I've already been able to lower my cost basis to $250 a share because of the premium that I've received of over $7 per share. And right now Tesla was trading or pretty much closed at $249 per share. So really on a net basis, I'm down about $1 per share on those shares, and I will be selling more calls for next Friday, thereby receiving another $7 or $8 credit, thereby lowering my cost basis even further for Tesla. So that's going to be the plan. Again, if you want to get access to all the trade alerts and ideas, including our MoneyVest website and the Discord access, link's going to be down below. The first week of the month is the best time to join, and we'd love to have you on board. And since we've had a lot of new people join our community, a lot of our new subscribers, new members, everybody, there's been a lot of influx of new viewers. There's been a lot of questions, and I really want to address this comment from yesterday's market update, which said a little bit about the cash exposure in the market. So this right here was from Pickleball Mike 509. Again, thank you so much for watching, and I really do appreciate every single person. And since there was a lot of likes on this comment, I figured I'd address it in this video. So he says, and I quote, "I like your videos. However, at the end of this one, you say with everything that's going on with it, which is the geopolitical tensions as well as the port strike." The biggest strike since 1977. So those are everything that's going on in the economic conditions here. You're getting cash ready, right? So, but the thing is, you always say you're cash ready no matter what's going on. So the way I'm going to address this is in a very simple format. So what I have for you is the liquidity framework. And, again, I'm not picking on anybody, but the comment really does kind of help me better understand where you are in your investing journey and also how long it's been since you have been a part of our MoneyVest community. Because the way we operate here is we don't make predictions, right? We look at risk and reward, and we also have a very good idea of how the market positioning is. Are we favorable, unfavorable on a risk reward basis? Is it time to actually be deploying a lot of capital, or is it time to be a little bit more defensive? So yes, while I'm personally very much invested long term, and I will continue to believe that there is optimism and there's more bullishness over the long term, I still am very tactical in my approach. In other words, I do like to play around with my cash exposure. So when I say that it's time to get cash ready, what I mean by that personally is that I'm raising my cash level in order to be prepared for the next potential dip or a correction or a volatility spike. So as you know, we go over the MoneyVest dashboard, which is a combination of a lot of other technical indicators and metrics that we like to follow. And that's a very good guide for myself that I've developed over the years to better understand how favorable it is to be buying in the market. And if it's not favorable, right? If the markets are at an all-time high, volatility is extremely low, everything's overbought, everything's overvalued, and if it's just really not favorable to be deploying capital, what do? I start to become more and more cash ready. And what I mean by that is that I start increasing my cash exposure. And that will go from 10 to 20 to as much as 30%. So for example, right now I'm sitting at 25% cash. I'm ready. If the market gives us any opportunities, if it drops another 5%, 7%, which by the way, Tom Lee also mentioned that it is possible, right? He's cautioning investors for a potential dip in the US. So if that happens, of course, we're going to be ready, right? So that's exactly the whole idea. Now, you don't need to be cash ready. Everyone's going to be different. Everyone's situation is different. Everyone's got a different risk tolerance. So if you want to be fully invested in the market and not have any cash available whatsoever, less than 0%, you want to take on more margin and be all in, that's completely fine. That's your way of investing and nobody's questioning that, right? So everyone's going to be different. Everyone's market participation and the style of taking on risk is going to be different. All you have to figure out from watching these videos, from understanding about market dynamics, risk reward, technical positioning, everything that we talk about on the channel, well, you have to figure out where do you want to be in this liquidity framework. Do you want to be less than 0%? You want to be somewhere between 0 and 5%? You want to be 5 and 10, 10 and 20, 20, 30, 30, 50, or over 50%. Now, there are some general rules of thumb that you may want to consider. Like if you are over 50% cash and you are incredibly underinvested, then, I mean, you're really missing out on a significant amount of opportunity cost because your green days are going to compensate for those red days and more, right? So if you miss out on the 10 best days in the market, your returns are going to be significantly lower than somebody who's invested in the market, right? So time in the market will certainly beat timing the market. So if you are over 50% cash, you may want to rethink your strategy. Unless it helps you sleep at night, then I'm not questioning it. If you are less than 0%, meaning you're borrowing money to invest into the market, then you're really going to be distressed because one potential drop of 10, 20% and your account's going to get blown out. You're going to get margin calls left and right, and that's it. That's going to be the end of the story. So you have to figure out where you feel comfortable. You can be somewhere around, like I said, 0 and 50%. Whatever number you pick, you decide what's going to work for you and stick to it. And you can fluctuate as the market conditions determine that those numbers need to go up or down, right? So for example, if the markets become incredibly unfavorable, my cash exposure goes up 25, 30%, which is where it is right now. If markets drop, by the way, if you go back to 2022, if you go back to even last year in October, my cash exposure was down to less than 6%, less than 5%. Why? Because I'm buying stocks, right? I'm buying and deploying capital into the market. So when you're buying, obviously you're putting money to use, putting money to work, and that's how your cash exposure goes down. So that's the only thing that I wanted to get across in these videos. And I do appreciate all the comments. So please, if you have any questions, let us know. But that's how I like to structure things. That's how I like to approach the markets from a risk reward standpoint. So hopefully that was a little bit helpful and got you a little bit of an understanding of how I view risk and reward, market positioning, and how I go about investing in the markets here in general. So we did have Big Three pushing up over $28 billion. We had Magnificent Seven down $32 billion and Top 10 $13 billion. Some of the big leaders on the day, Nvidia, $45 billion gain, up over 1.5%. Then we had Broadcom, $14 billion. We had Salesforce. We also have United Health. We had Apple pushing up almost $8 billion. We had ExxonMobil, Eli Lilly, BlackRock, Clark Corporation, and Applied Materials up anywhere from $3 to as much as $8, $9 billion on the day here. And this right here are the stocks that were selling off. Of course, Tesla down over $30 billion, over 3.5% lower after the delivery numbers. Microsoft, Google, Alphabet, and we had Meta Platforms, Nike selling off very aggressively. So I've got a video coming out on Nike very soon. You got Walmart, Merck, Amazon, and Humana, all of them selling off very, very aggressively. Now, the East and the Gulf Coast port strike could be a no-win situation for the Biden administration. So President Joe Biden has said that he will not intervene to force striking ILA union workers back on the job in the East and the Gulf Coast ports. So that again could be a little bit more of an issue because it could prolong the strikes for longer, thereby causing supply chain shortages and issues to the economy. I think if it goes on to a couple of weeks, that's going to be about a 30 basis point hit to the economic situation, which is the GDP. And the longer it goes out, the more problematic it's going to become. This right here, Israel retaliation may target Iran oil infrastructure, boosting prices further. And that again is another really, really important and critical red alert market item which could affect oil prices higher, thereby putting a lot of pressure on inflation. So really the bottom line is the biggest concern right now among investors is going to be what is all of this going to do to inflation. And Tom Lee was on CNBC earlier today, and this right here are some of the things that he mentioned. These are some of the things that exactly what I talked about in our yesterday's market update. But he said cautious near term. There is going to be uncertainty all the way through elections. We're 35 days away from elections, and investors just do not know how to discount these two things. That is the tensions in the Middle East and the port strike that could potentially cripple the economy. These are his words. I'm not even talking about what other people are saying. These are Tom Lee's words. That port strike, largest since 1977, we don't know what that's going to do to the economy, could potentially cripple the economic conditions. And of course, there's also tensions in the Middle East that could spur, some supply chain problems for oil, thereby increasing the price. We also did see a spike in oil prices today. We were just over $71 per barrel. At one point, we were well over $72 per barrel as well. And he says, if we get a dip, you want to buy that dip because we have a lot of tailwinds in the year end. And I could not agree with Tom Lee. This is perhaps one of the fewer times that Tom Lee and I are literally on the same page, where I do believe that there is going to be some uncertainty. We've got a lot of technical indicators and economic indicators suggesting for uncertainty going into October, as we are already here. And again, anything pre-election, investors are just not ready to commit capital as of yet. And post-election, November, December, especially in election years, it tends to be a very strong close. So that's what we're really preparing for. That's what I'm preparing you for, right? If there's going to be opportunities, if you continue to see some more selling pressure, buy the dip, deploy capital, get ready to essentially invest and put money to work, because November, December is going to be, in my opinion, a much stronger close into the year. So that's what I'm personally going to be doing, is buying more stock if there is better and better opportunities, with risk rewards getting better. If you do get a volatility spike, you know what I will be doing. So longer the strike lasts, the earnings growth could also get revised down for the S&P 500 companies, which also is not going to be good. It's already started. We'll go over that in just a second. And every time you've had geopolitical tensions, you want to buy that dip. Only exception was 2022, but that was also the beginning of a tightening cycle. And there is a lot of cash on the sidelines. Margin debt is low. Money market funds are at an all-time high. And there is a lot of firepower sitting on the sidelines. And the Federal Reserve, will be more concerned if the Fed got unanchored from an inflation standpoint, if the consumers got unanchored from inflation standpoint. And China, of course, launched a bazooka, and it's the best performing market in 2024. But really, it's this right here, which is going to be the biggest risk for the markets. And that is the Federal Reserve will be more worried if the consumer got unanchored on inflation expectations. If consumers start to actually believe, once again, that inflation is going to be higher 12 months down the road, that's a huge problem, because it is a prophecy that eventually, if you're believing it, it ends up happening, right? Because if we're expecting prices to be higher, what are you going to do? You're going to start buying a little bit more today in hopes of saving money, because you believe the price is going to go higher. If everyone starts doing that, that's going to result in prices going higher. So if people actually start believing something, they alter their actions, and that whatever they're believing is what ends up happening. So that's the biggest risk for the Federal Reserve, because then you've got economic conditions weakening, unemployment potentially moving higher, which we've got the data for later this week on Friday, and you've got inflation that is on the move again, reaccelerating back up, with these two tensions that are now front and center in terms of the global economy, right? So tensions in the Middle East, as well as the port strike that is causing billions of dollars out of the US economy right now. So S&P 500 Q3 earnings growth continues to be revised lower. So that was, again, that came out today. So the continued downward revisions is becoming a growing concern for equities as the market depends on earnings growth to push towards new all-time highs. While it's not unusual to see a downward revision heading into the reporting season, it's becoming a bigger concern for equities considering the need for growth in order for the markets to continue to make a new all-time high. And right now we're only pegged at 3.2%. Now here's another concern for the markets, because as I mentioned before, the markets doesn't really care about anything other than earnings. Everything that you can think about, whether it's the geopolitical tensions in the Middle East, oil prices going higher, inflation reaccelerating, recession coming online for the US, presidential elections, you've got the port strike, whatever you can possibly think of, everything is going to translate over into one number, and that is earnings per share. That's it. That's all that matters to the market, because at the end of the day, the S&P 500 is simply a multiple of EPS. That's it. If EPS grows, multiples can remain constant and the markets will make its way higher. If EPS grows and multiples expand, the markets are going to go higher. They're going to go faster, higher. If multiples continue to stay flat and earnings go down, all of a sudden you've got price to earnings multiple that is going to be more because the numerator is flat, the denominator is going down, which is the earnings. And as a result, there's going to be that vulnerability and that opening for selling pressure for the markets to recalibrate back to a more average, more median, and more appropriate multiple for the S&P 500. So hope that makes sense. And this right here is the VIX futures term structure. Again, there's insignificant backwardation. We're a little bit over 4.74% in backwardation here, with volatility expectations for October still pegged at over 20, coming down to 19 in November, and then post-election really just getting crushed down to 18.8. So this right here is where we are with the MoneyVest index. We were at well over 4.12. We've come down to 3.9. You can also sort of visually see that over here on this chart. As you can see that this right here is the dip. And again, the more recent number is 3.9. This will get updated tomorrow. But the lower we get, the better the opportunities will be. It's just that simple. You really don't have to overcomplicate things. 19 is where we are on the VIX, 57 percentile. Backwardation on the VIX futures, just under 1 on the put call ratio, and still majority of stocks trading above their moving averages, with the RSI at just over 58 at the moment. So this is again still flashing red or yellow, meaning that the buying opportunities have not presented themselves yet. We have to be patient. We have to allow for prices to come to us, and that's when we're going to be ready to deploy capital into the market. Mortgage applications down about 1.3% week over week. Refinancing index down over 2.9% week over week after getting a huge bump of 20% prior week. ADP employment numbers also coming in very strong at 143,000 jobs created in the month of September. And we'll see what the actual unemployment report looks like going into Friday. And that's going to be 142,000. Prior number, 132,000 consensus. Unemployment rate pegged at 4.2%, flat on a month-over-month basis for U.S. labor market. Now coming over to the markets themselves. First, going over to S&P 500. So this right here is the daily chart. So we were expecting a little bit of a pullback. So that is not a surprise. We did drop over 1.5, closer to 2%. So again, not a big sell-off, but support level is going to stay pegged at 56.67. That's going to be the first level of support, down to as low as this higher low, down to a much stronger 5,400 level, which again is possible. I'm not going to say that it's going to happen because nobody really knows. I'm not going to make a prediction, but if and when we actually come down to these levels, the MoneyVest index is going to roll down to 3, sub 3, and that's where the buying opportunities will be for us. Volatility usually, of course, when the markets are down, VIX is going to be much higher, thereby creating that environment for us to, once again, buy the fear, buy the panic, and get ready for that post-election, end of the year, Christmas rally. Let's just put it this way. We'll see what happens though. Coming over to the NASDAQ, and this right here is the overall breakdown on the technicals. Again, higher highs and higher lows, and this right here is going to be that higher low support. That's the ascending low. And of course, we've got the higher high. Support level is going to stay put down to 17,000 for the NASDAQ, and resistance all the way up to 18,300 to as much as 18,600. That's pretty much the all-time high for NASDAQ as well. Very quickly, going over to crude oil prices, we're coming up to that resistance again at $72 a barrel. Volatility is still in that range between 18 and 20. So we'll see if it actually does spike back higher to 22, 23, or possibly even up to 30s. And that's what's going to create that buying opportunity for us. And the money vest index, as we've already gone over, 3.5 down to 3, down to 2.4. Those are some levels to definitely keep in mind, because the lower we get down to, the better those buying opportunities for us as long-term investors in the market. And again, this is, you can also kind of look at this as a cash exposure standpoint. So if you are higher, so for me, 20 to 30% cash here, 10 to 20% cash here, then we got 5 to 10% cash here, and then less than 5% cash here. So that's how I like to operate from a risk reward standpoint, and how much I want to deploy into the market as it's getting better. As prices are coming down, risk is coming down with it. Now going over to Apple stock first, and Apple here really consolidating sideways, so not really moving much, but support level is going to stay put inside this green rectangle. Resistance all the way up to as much as 236. So a lot of consolidation sideways. So that right there is the range within which Apple's been trading at. Going over to Amazon, starting to roll over. Support level is going to be pegged at $180 down to as low as $173 for Amazon. Resistance is going to stay put at $189. Coming over to Tesla. And Tesla here, even after the pullback, got bought up fairly quickly. You can make a case that how it's making some higher highs and higher lows, and still within the context of an uptrend. But of course, we'll see next week what happens with the robotaxi event. It's going to be a very, very important day. For Tesla, we do have some buyers sitting at 236, 237. And Tesla right now is trading at just under $249. So resistance and a huge area of supply stays put at 267 for Tesla. Coming over to Nvidia, which managed to have a very nice gain of 1.5%. And right now starting to move back higher above this resistance. But really, it's been consolidating sideways for the most part. I've been viewing Nvidia for now almost 6 weeks. So it's been doing incredibly well. We were able to accumulate shares here in the $108 range. And since then, it has obviously rallied quite a bit, all the way up to $127 and back down to sub 119. So we'll monitor this, how it trades going into later this week, going into the unemployment print, and next week as well. And we'll see what we have to do in terms of our options portfolio and how we want to adjust that position. Advanced micro devices still within the context of a downtrend, however, higher highs and higher lows. So uptrend within a downtrend, resistance going to get tagged here at around 165, and support level down to $138 for AMD. So still within the context of a nice little uptrend for advanced micro devices. Now coming over to PayPal. PayPal, of course, has been a very good star of the show, outperforming the market, however, consolidating sideways. Support level is going to stay put at $76, $77, down to as low as $73, $74 for PayPal, and resistance all the way up to $88, $89 per share for PayPal as well. So this right here, a very strong resistance right now, near term, as much as $80, all the way up to as much as $89 per share for PayPal. Visa, on the other hand, also consolidating sideways after selling off from the DOJ investigation, bouncing off of that support. That's going to be sitting roughly at $272, $273, all the way up to $282 for Visa moving forward as well. Now coming over to Meta Platforms, and Meta here continues to trade near all-time highs, perhaps the only magnificent stock that is doing really well right now, still trading well within 1% of its all-time highs. Everything else is still got ways to go, especially its counterpart Google, which is still struggling at the moment, down almost 1% on the day. But Meta here consolidating sideways. Support level is going to stay put at 540, down to 480, down to 455 for Meta. Going over to Google, again, this is the area of support and demand at 167. Nice bounce back higher from those levels. It was incredibly oversold, so we did see a nice RSI, MACD, and L3 banker oscillator, everything kind of moving higher very nicely. But I could see Google kind of consolidating sideways a little bit here before finally breaking out back up to 176, 177. So that's going to be that level to keep in mind. Google is one of those stocks that, you know, if it does come down to sub 160s again, or possibly down to 165 or lower, I could see myself deploying cash into the stock or even selling puts on Google as well. But the premiums are not that high for Google. But we've got a secret sauce in our community when it comes to running the wheel, and we'll talk about that in our Discord as well when it comes to selling options, puts and calls. Microsoft definitely been very, very weak, so it continues to sell off here from its highs of 442. It's already fallen a little bit over 5.5, almost 6%, and definitely weighing down on the market here. Support level is going to stay put at $400, so this right here inside this green rectangle is going to be that support level to watch for Microsoft, and resistance stays put at $432. And then finally we come over to Enphase and Costco, and Enphase here Again, continues to sell off, down almost 3% on the day. Lots of consolidation sideways in that range. I do believe 2025 is potentially going to be the year for Enphase. Resistance is going to stay put at 124. Support level inside this green rectangle at $96, $97 for Enphase as well. And finally, we come over to Costco. Just consolidating sideways, also coming down to that support at $870, resistance all the way up to $920. And Costco is one of those stocks that, in my opinion, is very expensive at the moment. So things to pay attention to: we got the port strike, we've got the geopolitical tensions, we got the unemployment numbers coming out. Keep a close eye on volatility, the money vest index, the market technicals, and get ready with cash. In my opinion, I'm already at 25%. See what number fits well for you in the liquidity framework, and you can work around those numbers to see when the risk reward is favorable for you to deploy capital into the market. So hope you all enjoyed this video, found it helpful. Make sure to drop a like and subscribe to the channel, and also share these videos with your friends, family, other traders, investors that can benefit from all the information here. Happy investing. I'll see you all in the next video.